Hello and welcome to Market Call. I'm Mark Bunting. For the next hour, we have David Burrows here, President and Chief Investment Strategist at Barometer Capital Management. He'll take calls, emails, and tweets on North American large caps. Phone us, email us, send a tweet at Market Call if you have a question for David, or you can upload a video question by using the social media platform of your choice. Hello, sir.
How are you today?
Very well. You're always very good at putting things in perspective for us. So we know that in the past you've said we're in a secular bull market. Tell us what's happening right now.
Okay. So first of all, we do believe we are in a long-term secular bull market for stocks. Money is slowly working its way back into equities after 12, 13 years of leaving the asset class for developed markets. But even in a secular bull market, you have very significant and sometimes a little hair-raising corrections. If you look at the 80s and 90s, market averaged 18% a year over that 18-year period. But there were 6 or 7 significant corrections along the way. Now, a correction in a bull market has some pretty specific characteristics. They happen fairly quickly. They are painful because people, are thinking back to the previous market, like period between 2000 and 2012, where there's some real big corrections that they're concerned about. But they run through the market, they reset, and then leadership resumes, and ultimately markets work their way higher. So tactically, as investors, there's a couple of ways to handle them. You can sit tight and hope for the best. That's not what we do. At Barometer, we're a fairly tactical investor, and so we do make some moves to protect the portfolio through corrections, which we've done. But I do believe, based on the work that we do, we're a long way through this correction. We don't sell opinion. We use some very specific tools to help us make decisions. And one of the things we look at is the percentage of stocks within a market that are performing well technically. And we know when you've got high risk, you might get to a point where 70 or 80% of stocks are performing well, which means everything's doing well. Late in a correction, you might get down to 15 or 20% of stocks and everything else is sold off. And over 60 years, anytime this indicator got below 30% and then ultimately started to improve, meaning more stocks started to behave better, the risk reward was very good for investors. So in that period of the 80s and 90s, there was 6 periods where that took place every single time when things turned higher. Within weeks, if not a couple of months, markets working its way higher again. So we got there in August. You get 2 types of bottoms. You can get a V bottom, or you can get one where the market works and puts in a bottom. It looks as though we're going to retest the lows. We may even undercut the lows. But at this point, the risk reward is very good. And we think that the rest of the year, the fourth quarter, probably winds up being pretty good.
Okay, a series of questions here. We know you use stop losses. Were you stopped out of a lot of positions the last month or so? And what's your cash position? And what have you done to protect the downside?
So yes, we do use stop losses. And we are in a market where up until very recently, there was some very clear leadership and some really rotten groups, like for instance, commodities and energy, which we've been quite negative on for some time, and emerging markets. Our view was if things got bad enough in those groups, it could wash over into developed markets, which of course it has. So the one key leadership group that really has taken it on the chin in the last couple of weeks, of course, is healthcare. Which means we've been stopped out of a lot of positions in healthcare, which has been a great sector to be in for the last 3 years. 2 key sectors have been remarkably strong. Consumer discretionary, which is the biggest beneficiary of low energy prices. Lots and lots of stocks holding up well.
Like a Nike.
Relatively. Like a Nike, like Starbucks, lots of names we've talked about, Home Depot. And second, and most importantly, financials. U.S. financials, if you look at what percentage of the stocks are behaving much better than the market, is the second highest diverging group. Now, if we've got a systemic problem and you think we've got a crisis on our hands, that's not the way financials behave. They are not pointing to a severe bear market or something that's prolonged at this point. So we have hedges in the portfolios and the pools that we run, we can hedge against the market. We have roughly between 40 and 50% of our portfolios exposed. The rest are hedged because we take responsibility for managing exposure for our clients. We do have cash in all of our portfolios, but the key number to take away is we're roughly 75% in the US, which we think is the strongest market, and of our market exposure, we're roughly 60% hedged against market risk. those hedges can come off very quickly as things turn stronger.
All right, very good, David. Let's take a short break, and then David will start answering your questions on North American large caps.